Hello and welcome to Class 2. Class 2. Today I want to talk about forex terms and terminologies and jargons. Those things you hear forex trader talking about and you're like, what the heck are they talking about? Yeah, we'll talk about those today. The first term we'll talk about is currency pairs. Currency pairs, like I said in the last class, is two currencies paired against each other, traded against each other on the forex market. Amongst currency pairs, we have major pairs like Euro USD, GBP USD. We have minor pairs, and we also have exotic pairs. Next term we'll talk about is lot size. I talked about this in the last class. Lot size is the size of your contract or trade. A standard lot is 1.0 and is equal to 100,000 units of the base currency that is being traded. So for example, if you are buying Euro USD, it means that if you are buying Euro USD with 1.0 lot size, it means you are buying 100,000 euros. Alright, and then if the value goes up and you sell, you will make the amount of profit you would have made if you had actually had 100,000 euros in your hands, right, and waited for the value to increase and then sold. That is the idea. Next, we'll talk about the strategy. Your strategy is your trading style, is your methodology. We have many different types of traders, many different styles of trading, right? And your strategy is what would determine what kind of trader you are. Are you a smart money trader? Are you a support and resistance trader? Are you a scalper? And there are many different styles and methodologies out there, right? So when you hear strategy, it's just talking about the methodology, the things that the trader looks out for to form their own trading style. Next is broker. What is a broker? A broker is a company that provides you access to the market. It's kind of like a bridge between you and the market, right? It's a company that provides you access to the market to place your trades and generally to be a participant in the market. Another term you hear frequently is leverage. What is leverage? The idea of leverage is now on the market there is a certain amount of money below which you cannot use to participate on the market, right? So for example, you are supposed to participate on the market with at least 5,000 US dollars. You need to have 5,000 US dollars to be able to place a trade of 1.0 lot size on gold versus US dollars. Now you don't have $5,000. What you have is $100. What the broker does is they give you options of leverage. You have leverages of 1:100, 1:500, 1:1,000, 1:50, 1:10, 1:30. Different leverage options like that. That that ratio, 1:30, 1:100, that ratio is the ratio of your account size, your capital, versus how much your broker is willing to lend you to make up for you to be able to place your trades. For example, you have $100, but what you need is at least $5,000 to place the trade you want to trade. What your broker does is that they will now lend you, depending on your leverage, they'll lend you a certain amount that is a multiple of your capital. So say you have $100 and your leverage is 1:500. 1:500 means your broker will lend you the amount that will make your capital equal to 500 times your actual capital. 500 times your $100 would be $50,000, right? So your broker will now lend you $49,900 to add to your $100 to make it $50,000. Sounds incredible, right? Oh, now you can't withdraw that money. It's just there to help you to be able to place your trade. So what happens is, if the trade goes in your favor, then you make some profits, and your broker takes back their $49,500 at no extra charge, no extra cost. But if the trade goes south and goes in a loss that is equal to the $100 that is your own, then the account is gone, the money is gone. Your broker will withdraw their own $49,500 and your capital is gone. You have to find another money to deposit. That is how it works. They give it to you at zero risk. They're not ready to risk it for you. They're just like lending it to you to help you to be able to place your trades. So you see, 1:100, 1:1,000, 1:30. That is just what leverage means. Entry. You hear things like entry. Where's your entry? Entry is the point at which price was when your trade was executed. Right, that is your entry. The point where price was. Stop loss. Stop loss is a safety precaution to help you cut your losses short anytime you are wrong. So it's a point that you preset and say, if price gets to this point, automatically take me out of this trade. It means that the trade is a losing trade and I don't want to lose more than this amount that has been lost already. That's what stop loss is there for. If you don't have stop loss, if you trade without a stop loss and you are wrong on any particular trade, it could lead to very, very huge losses and could even lead to the loss of your account. Right. Take profit is also a point on the charts, is a price level actually, where you step out of a trade which is a winning trade in profits. So you want to step out of a trade with a profit that you have made at so and so point on the chart. You place your take profit at that point. When price gets there, takes you out without you being online or without you having to come and close the trade yourself. Then you hear terms like break even. Also, break even is the act of moving your stop loss to your entry point to preserve your capital. So say you place a trade has gone in your favor to some extent, and then you move your stop loss from where it was to the entry point to preserve your capital, so that in case something happens, you're not online, whatever, and price decides to return back and violate the setup, you will be out of the trade with no profit and no loss. Just your capital is preserved. Right, and then the last term we'll talk about today is trends. You hear trend. The trend is your friend. The trend is your friend. On the markets, when we're talking about trends, we mean the directional bias of the asset that you are looking at. The directional bias. What is the general direction of this asset I am looking at? Now, the market does not move in straight lines, but when you look at the charts, you would know what the general direction is. There are three major trends in the market. There is the uptrend or the bullish trend, there's the downtrend or the bearish trend, and then there's the ranging market or whipsaw market or sideways market. All of them mean the same thing. All right, we'll go into all of these in more details in the next class. Thank you and God bless you. See you in the next class.